Welcome to Coffee and Keys, where we blend our expertise and personal experiences to unlock your awareness of the real estate industry.
They're the best.
Here they are.
And now, here's your hosts, Darlene Kemp and Crystal Jacques.
We're back for another podcast.
We are. And it seems like there's so much time in between. I mean, so many things happen. And
I know. So many more stories to tell, right?
So many more stories to tell. But let's kick this one off with some good news that I like to hear as an agent. And that's the two words, offer accepted.
We have a ratified contract.
Contract.
Now everybody goes, now what?
Yeah. After we celebrate and cheer, but there's things that need to be done. And for a buyer, there's always things that need to be done.
Right. Yeah.
But
that's like the starting point is when you have a ratified contract. Now we need to get the ball rolling and do all those other things. So what we're going to talk about today is what are things that can happen after you have a ratified contract, right? Yeah,
because you know what? You might as well call a buyer a track runner because you're always hurdling, right?
I always said it's either hurry up and wait. Hurry up and wait, right?
Yeah.
We're waiting for this. Then you got to do this. And then you're waiting for this.
And then you got to hurdle this. And then you got to hurdle that. Then you got the loan officer saying, I need this. And,
I need that.
If I don't get it right away, they're reaching out to us as the agent. And the agent's saying, I need you to get this. So there are probably the top 4 issues that I, as an agent, hear in every transaction. That need to be hurdled, right? So the first thing is I'm gonna lay them out, Darlene, and we could go one by one.
Yeah.
Okay. So the first thing is a term that I use quite frequently before and during the transaction, and that is called an appraisal gap. What is that? What is an appraisal gap? Because I explain that in every transaction.
And that one's an important one for lenders as well. So it is.
Yeah. It is important. The second one is our title issue. So what is title? Yeah. Because we use these terms daily, but we have to understand that our buyers may not understand what these terms are.
Yeah.
Okay.
Yeah.
So title issue is number 2.
Okay.
Undisclosed debt. What is that?
Lender issue. I can definitely help with that one. And we have seen undisclosed debts before. Then as you get into that loan, all of a sudden something shows up that, you didn't know about. So yeah, that's a good one to talk about.
And the third one, or the fourth one, the fourth one, which we are hearing a lot about from different perspectives, is trouble getting insurance. Mm-hmm. And there's various reasons why we can't get it or we have a problem with getting it.
Or it's a lot more than what you initially estimated. And there's some reasons that we can talk about on why it came in much higher than we estimated, right? And, when a part of that payment comes in higher than you thought, it could actually run into a risk of qualifying.
Right. And I think we were talking just recently and you're going through this with a file.
Yeah. Insurance came in so much higher and now it actually pushed them over that qualification ratio. So we got to figure out what we can do to make it work. Yeah.
All right. Well, let's start with number 1.
Okay. Number 1.
What is an appraisal gap? Because I, as an agent, add on another word after an appraisal gap, and that is a guarantee. So what's the difference between an appraisal gap and an appraisal gap guarantee?
Well, let's talk first about the appraisal and why it's important. So from a lender's point of view, once we have a ratified contract, we're going to run it through our automated underwriting system, right? Now, every once in a while, it'll waive the appraisal, but that doesn't happen very often. Most of the time, it's going to require an appraisal on there. And we're going to base that loan amount based on what the house appraises for, right? So you have a ratified contract, let's say $300,000, right? And the appraisal comes in at $275,000. We're $25,000 low. That's a hard one. That's what they would call an appraisal gap. There's a gap between what the appraisal came in at and what your purchase price is, right? And
that's the gap.
I am going to base the loan amount on the lesser of the appraised value or the purchase price. So, even if they were doing 100% financing on a VA loan, the max we're going to give them is that 275. So now
Wow.
up with 25,000 cash if they still want to buy that house.
And that's the guarantee.
Right. And that's where, right. So now sometimes, basically when I'm looking at it as the lender, we're only going to lend the loan amount based on the appraised value. Mm-hmm. Right. So it doesn't mean that it kills the deal. It just means now the buyer has an option, right? He could either pay the difference in cash, or depending on how the contract's written, right? And that'll be your end.
Right.
Negotiate the contract.
Right.
Or if it was contingent upon the appraisal and it didn't appraise, the other option, they could walk away, right? Is that basically three options?
3 options.
Yeah.
But you don't want to walk away. I mean, everybody's invested at this point. The seller's invested,
and
the
most
buyer's
of the time you
invested.
don't have that big of a gap, but I mean, sometimes you do,
but
most
back
of the
in
time it's
19
one
and
or
20,
two.
you did.
Yeah.
2019, 2020, you had those gaps.
Yeah.
So people were guaranteeing.
They were making offers and making it, they guarantee that, like you said, appraisal gap. So if the appraisal came in low, they were upfront agreeing to pay that difference rather than waiting for the appraisal to come in and then determining whether or not they wanted to do it or could do it. If they didn't have the cash, they couldn't do it. Right.
We were all rolling the dice back then.
Yeah.
I mean, I had some people that put in offers 30,000 above, and we would guarantee it. We'd guarantee that 30,000. But then there were some times that it did appraise for that. So they didn't have to bring that money to the table.
Right. It's just there as kind of like you said, it's a appraisal gap guarantee, which says we're going to pre-negotiate up front. If the appraisal doesn't come in, we know the lender is only going to lend off the lesser of that sales price or appraised value. So we're agreeing that if it doesn't appraise, then we're going to bring that money to closing usually up to a certain dollar amount, right?
Yeah.
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 So and that's, when you're in a multiple offer situation, that could be the thing that wins the deal, right?
That usually is when you say you're going to guarantee, and you don't have to guarantee all of it. So some of it will say, like there's been times where some of my clients didn't have that kind of money, right? But we shot, maybe it'll appraise. Maybe, we shot for 20,000 over the list price. But then they would only guarantee 5,000. So maybe, we put in an offer for 300, and the list price was 290. And instead of saying, we're going to guarantee the amount up to 300, they might say, you know what, I'll guarantee up to 295, and maybe it'll come in at 295 or 300 or whatever.
Right. So basically the borrower is just saying that I'm guaranteeing it up front.
Right.
But let's say you have somebody that, because we talked before, anybody could sell their house for any dollar amount that they want to, right? Anybody can buy it for whatever dollar amount they want to.
That's a good point because I think buyers think that we as the agent, we are telling the seller what to list their house for. It's not necessarily true. We recommend based on our comparables what to list your house for. But guess who has the overall say so?
Right. Yeah, the seller.
The seller. I have one now that, I recommended a price. He said, no. I think I can get about 20, 30,000 more. I know this area. The people down the street, they got that much more. And so I have to, as an agent, go with what he wants. We went 30,000 above what I thought it should be. And guess what? We didn't get one showing, not one. So that tells you that they're too high.
Yeah.
So eventually he took an offer. Some sensible buyer comes in the door and says, okay, well, I don't see it. I don't see where you got this price, but you know what? It's worth putting in an offer for what I think, I want to pay and what I think is reasonable. And my seller took it. Yeah. Which was $30,000 lower.
Right. And then, but you still have it contingent upon the appraisal, because most contracts are contingent upon the appraisal if they need financing for sure. Right. Most loans, not all, but most loans do require an appraisal on the property. And even if you go into a property and you offer them whatever that list price is, it doesn't mean it's going to appraise for that. You could still end up with an appraisal gap. So once we get the appraisal in and we see what the value is, if it meets value, it doesn't matter if it exceeds it by 10,000 or whatever, all they're paying is the purchase price, right? So they're not paying. There's some buyers who get worried about the appraisal because they're afraid it's going to appraise too high because they think they have to up their contract price for it. But no, you're going to, when you write that offer, right, they're paying that price. And then the loan and the lending is contingent upon that appraisal coming in at that value. Right. And then so then if the appraisal comes in a little bit low, then we have to look and say, does the borrower have the money to pay more, and is he willing to?
Yeah. Well, I don't think I've ever had a buyer or seller not agree if it came in lower. I mean, that's just negotiation at that point. And that's negotiations using your agent, on behalf of their client.
That's why you need a good agent to, number one, know how the contract's written originally and the offer's written originally, so everybody understands what that means for the appraisal gap. And then also, once that appraisal comes in, you're back to renegotiating. It's not a guarantee that hasn't already been put in there up front.
Right.
Yeah, so it takes a good agent to help with that.
Yeah, that's a good one, because I honestly, when you say, I've had some buyers say, what is an appraisal? You would think that, as educated as a lot of buyers are, because we have the internet and we have the web and, there's all kinds of tools. I get those clients in the door all the time. But something as we think as simple as an appraisal, they don't know what it is, and especially an appraisal gap. So
what that means to them. And really, when they're making that offer, we want to make sure that they understand what that means to them. Right. All these different
how important
things
it is
that are going to come up. Yeah.
Because they think when they see that sales price, they think either the agent says, this is what it's going to appraise for, or this is what it's worth, or the seller says, this is what it's worth. But it's not always true.
Right. So you got to do your due diligence as you're making the offer. Do you think it'll appraise? Do you think it won't? And how do you want to write that offer? So that's all in the negotiations. And again, whether it's a buyer's, we talked about this before, buyer's market, seller's market, how that makes a difference in how you bring your offer in. Right. So when you're in a seller's market, that makes all the difference in the world. Right. Exactly. To negotiate any gaps in there.
So buyers, when you shoot higher than the list price, keep that in mind, that it doesn't always mean that house is worth that. And if it's not, what's the next step?
Right. So again, as a seller, if you don't have what you use the word guarantee, then that simply means that the appraisal doesn't come in, you don't have a ratified contract anymore, right?
That's right. Exactly.
And you're back to renegotiating. So now that buyer can either walk, or that they don't have the funds, or the seller could come down to the appraised value, or you're kind of back to that. But yeah, unless it has that appraisal gap guarantee in there with a certain dollar amount, it doesn't mean it's going to happen, right?
Yeah, I've said to a couple of my buyers before, because they put a house on the market. You got two people bidding against each other, and the price is going. The sales price is going up. The offer amount's going up, and so then they get all excited. I go, well, wait a minute now, because that doesn't mean anything if you don't close. So let's stay within reason. And if you like that amount, let's go back and ask for protection so you'll get that amount. Right. That's what's exciting you.
Exactly. Because anybody can say they're going to pay you this for it, but if the appraisal guarantee isn't there, it doesn't mean that it's going to end up closing at that sales price. Yeah.
That's right. So just keep that in mind on both sides, sellers and buyers.
Yeah, exactly. That's the thing. just because you're ratified, that'll be something that you'll also have to take a look at and could change things between the time of ratification and the time of closing.
Yeah.
And those are the things that we're talking about today. So what's one of the other things that
Okay, so the next thing is, and this is a word that we use all the time, title.
Oh, yeah.
It's got to go to title. What does that mean?
You do title search.
Title might have an issue.
Yeah. And again, a lot of that has to do with lending, right? Because we're going to give you a first mortgage, which means that we're going to lend to you and the property is used as security for that loan. So the event that you don't pay, right?
Right.
We could then force a foreclosure and have you sell the property so the lender gets paid back in the event that it goes into default, right? So we want to be in what's called first lien position, because if you have a foreclosure, right, it's sold like an auction on the courthouse steps. And whatever they come out there and bid on that, the amount at that foreclosure, then they're going to pay off the liens based on how they were recorded. The ones that were recorded first get paid first. And when there's out of money, the rest of them, they don't get paid at all.
So they're recorded at the city offices, right? The recording office of the city that the house is in.
Right. So once you go to closing or settlement or whatever you call that, depending on the state, I know they call it escrow. Or so whenever you go to closing, then that settlement company or attorney's office is then going to take those documents, the deed, which changes the name, right? The ownership. And then also the deed of trust or the mortgage gets recorded. And what the title company is going to make sure of, or the attorney's office, when they close that deal, is that that lender is going to be the only lien on that property at the time of closing. So that if they're the only lien, they're in first lien position.
Right.
So, so the title company attorney's office, they're going to order a title search. So they're going to go down to the courthouse and they're going to search that title. And there's a couple of things that they're looking at, right? They're looking at who owns it.
Few things.
Right. So all the people who own it have to agree to sell it and have to come to closing to sign the deed to transfer that title to the new buyer.
Right.
So they have to know who owns it or who has rights to this property.
Right.
So that's number one. Number two is liens. So anybody who has recorded a lien on the property, the strength of that lien is based on who was recorded first. Right. So let's just say, the previous owner had a first lien and a second lien. And let's just say, oops, maybe they had a judgment. And a judgment is lien on real estate as well.
That's actually quite common.
It really is.
It is.
So if you have a first lien, a second lien, and then a judgment, and the settlement company goes out and does a title search on it, they're going to say in that title search that the at closing, the seller has to pay off the first lien, the second lien, and the judgment, so that it releases all liens from the property, so that when we go record our deed of trust or our mortgage, that it is now in first lien position.
So those items are paid from the proceeds. So it's kind of subtracted on your closing disclosure. It's not like you got to run down to the courthouse. Yeah. You don't have to run down to the courthouse and pay it.
No, they're all paid off at closing, and the settlement company, the reason they get that title search, so they know it has to be paid off, because that'll make sure that the lender's in that first lien position if they're getting a mortgage loan. But even if they're not getting a mortgage, the person buying it wants to know that there's no other liens, because when you sell your property, you're selling your property and all liens that are against it at that time. So that new buyer would then be responsible. They couldn't sell the house without those liens being paid off. Right. Yeah. So those are things that we'll see as title issues. So what if it comes back that there was some other owner on the property? Maybe they didn't record, a deed of gift, or maybe something was there. So they gotta clear up who really owns it. If it's an estate sale, did you follow all the rules from an estate? So there's some things that could come up in the ownership of the property. And is that person allowed to be the one to sign at closing to sell it?
Right.
But then the next most common one is unreleased deeds of trust, where you had a lien that was supposed to have been paid off on a refinance, but they never recorded the release when it got paid off.
And it was so when you pay off, and I've been in this situation, when you pay it off, you should get a letter from the lender saying that you have paid it off. Keep that letter, because they may not record that it's paid off, and that's
or maybe
your
it was
proof.
recorded under the wrong deed book, page
yeah.
number, whatever that might be, so that it wasn't found.
Yeah.
So yes, the minute a loan that is a lien on a property gets paid off, they're supposed to issue what's known as a certificate of satisfaction.
Right.
And that certificate of satisfaction is recorded at the courthouse,
Right.
and that lets the public know that that lien is no longer valid. It's been released.
So if you
you've got
have
a lien without a release, it's still a lien on the property.
So if you're a seller and you're in that position, it could not always hold up a closing if you have title insurance, correct?
Correct, but it also depends on the lien. And this is where we remember when we had Kedron on. That would be a nice topic to go back and just talk about that a little bit. But yes, if the seller had purchased the property and he got lender's title policy, which is typically required because the lender's going to want to have that protection, but they have an option to have an owner's title policy at that time too. So that owner's title policy would protect them if an unreleased deed of trust prior to them buying the house pops up. But if they went out and did a refinance, or they went out and did something after the policy was issued, they could still delay closing to get that cleared up. Normally those things can be cleared up. They just take time, right? If you've proved the lien was paid off and now it's just a matter of going back to the old lender, making sure they sign that certificate of satisfaction, and then it comes back so it can be recorded at the courthouse. Those are issues that can be cleaned up and cleared up. But sometimes they just take time to track down the lender and get the lender to sign that certificate of satisfaction and get it recorded.
So it kind of behooves you, or whoever you close with, to start doing the title search immediately. And I believe that both sides, the buyer side and the seller side, does a title search, right? And they kind of meet in the middle and see if they've got the same information, correct?
That would be a good title company question. Sometimes the buyer's company will send a copy of the title report to the seller's company, but sometimes, it's the seller's closing company that's responsible for handling any issues. If there is a lien that needs to be taken care of, that would be the seller's responsibility because they're the one who's guaranteeing clear title, right? But again, when it comes to talk about, not that I'm a pro on title insurance or anything else, but one of the reasons, we always highly recommend getting a buyer's policy is that guarantees that if an issue arises, that
you've got protection.
You can be protected there.
Yeah. I always recommend that.
Yeah.
I mean,
think about
there's
how long
buyers.
the land's been here, right? Since the beginning of time, right?
Right.
You never know.
I mean, they could go back. I mean, if you're closing with an attorney, they usually do what we call a chain of title, which means they'll go back. Back all the way to the beginning of that house. I mean, we owned a house. Yeah,
but think about it. The builder had to get that property from somebody else, whether was agricultural.
Right.
I mean, it can go back a long time. But you're right. They do like a chain of title to make sure that not only all the owners are the owners that were allowed to sell it, but in each person, when they sold it, depending on the type of deed, but most of the time, they're guaranteeing that they're giving you clear title. So another reason to have the owner's title policy, because let's say you've sold it and then all of a sudden somebody came back and tried to make a claim prior to you, then you guaranteed clear title. And if it doesn't have clear title, you could be responsible. So that's will help protect you on that as well.
We owned a house in Chesapeake, Virginia at one time that I was looking at the chain of title, and it went back all the way. It said that George Washington owned the land that house was built on.
Now, cool.
I'd like for him to come back and tell us that was his land.
Right. Well, here's the issue on that too. Anybody can make a claim, right? Anybody can sue. It doesn't mean that they're going to win. So they could make a claim thinking that they have some type of right into the property. It's not to say that they're going to win, but think about the cost of the attorneys to fight that in court for you when you're paying just a small amount at closing for the buyer's title. That would take care of that for you.
Right.
So that's what I always like to say. But, either way, once you've got that ratified contract, that's one of the very first steps. Usually we'll get a copy of the ratified contract, and then we will order what's known as a title search, and we will just send over what we're requiring as a lender, clear title, first lien position, all these things as a lender, to be able to close it. So we'll send those instructions out to the settlement company so that they can order that title search and start that process as well. And
Awesome.
title comes back and it'll have instructions. And as long as we close per those instructions, we're good. But if there's an issue that comes up, what we're hoping is that they'll get that title search in and look at it in plenty of time to clear up any issues before closing. Like sometimes, think about it. Judgments are liens on the property, but there's a lot of people out there with the same last name, right?
Right.
With the same name. So it could come up that, you need things like, like a judgment affidavit that says, this is not me. This is not, who I am.
Right.
That also gets recorded to clear that up. Or let's say, if your husband and wife, you own it by tenants by the entirety, then if only one person's on the judgment, it still doesn't attach. So you have to have a marriage affidavit or something like that. So again, this would be a great topic for Kedron to come back and talk
Come back and do it. Yeah.
Talk about title insurance. But there's a lot of different things that can come up. So the biggest thing to remember is once you've got that ratified contract, there's still things that could happen that could delay closing based on what that search says. So
Great topic.
Yeah, that one we could definitely go deep in depth with.
Yeah.
But I'm not a title expert. That would definitely be
Neither am I.
where Kedron would come in and kind of really help out with that one. So,
all right. So issue or hurdle number 3.
Yeah.
How about trouble getting insurance?
Oh, we've seen that, haven't we?
Ooh. You have a situation now.
Yeah, that's one of the things that's really tough now, because when somebody comes to me and I'm giving them, a qualification letter, it's based on what that payment's going to be, that expected payment's going to be.
Right.
So we know, we got the ratified contract, we know what the sales price is. And typically we can look up the taxes too, but again, they could always, it could be time for reassessments and it could be reassessed before closing. So the taxes could go up, right? But insurance is one of those things that we really just kind of guesstimate based on what we see averaged in the market. But there's a lot of things that can affect homeowners insurance, especially nowadays. We're seeing homeowners insurance really increase. And I just had one where he even, shopped around and it just, the insurance came in so much higher that it affected qualifying. So now the debt to income ratio was at an acceptable level. And now with the new insurance, it actually took him over the qualifying guidelines.
Oh boy.
So we have to figure out how we can get that debt to income ratio down a little bit.
Oh my goodness.
The insurance will make a big difference. And not only the dollar amount of the insurance, which a lot of things can affect homeowners insurance, right? If you buy in a property that had previous claims on the property, that could really affect it. So it's hard for us to estimate that because we have no idea what the claims have been on that property.
Yeah.
Or if a borrower themselves had a previous property that they had to file a claim on, that could affect their insurance. So really, we're just guesstimating at the time in the beginning. And until they actually get their homeowner's insurance policy and give it to us, we don't know what that amount is going to be. And that amount could affect qualifying. So those are definitely some things that can come up on that. So what are some of the things you've seen on?
Oh my gosh. Okay. So, well, I have a most recent situation with insurance because I sold a house a few years ago, and then I get a call from my buyer who lives in the house that the house burned down.
Oh my word!
So how does that
and
affect
that's why
going
you have
forward?
Insurance.
Yeah, that's why you have insurance.
Yeah.
But how does that affect it going forward? I was like,
So that house will have a claim attached.
It will have a claim because he has to have it rebuilt.
Yeah. Yeah. Thank God he had insurance, so he could have it rebuilt, right? So again,
he's working on it now.
Yeah. You always think that all these things will never happen to me, right? And then all of a sudden something, happens, and it's just nice to have the right coverage. But again, that the key there too is the right coverage, right?
Right.
So
but
not only do we have to make sure the coverage is enough.
So his question to me was, do I rebuild it and I live in it, or do I just sell it burnt almost to the ground and, move on? And regardless on what he does, it's going to have a claim against the house. When the next person comes in,
the house will have a claim and he will have a claim.
And he will have a claim.
So the next house he buys, even if he buys another one, it's probably going to be the same thing. Yeah. And I'm sure he could sell it for a lot more if he actually used the claim to repair his house.
I think so. Yeah.
Because here's the thing too, your lender, one of the things that as a lender, we'll order that insurance and we're going to give them what's known as a mortgagee clause. So the insurance company will also know know that the lender is on that insurance policy, so that if something does happen to that property, then the lender is going to require that that work get done and that money gets used for that work. And a lot of times they have to sign the check.
Aha.
For the repairs to get done to make sure that they are going to get done. Because remember that lien that they have is based on the house in the value of that house. And the minute it burns down, it's not valued at that anymore.
Right.
So the insurance policy is there to protect the lender, and it identifies the lender in the insurance policy for in the event that something happens. So in this case, if he did decide to sell the property and go buy something else, he doesn't get to take the insurance money with him. The insurance money is going to have to be there to rebuild the property. Regardless. So he might as well rebuild the property. And then if he decides to sell it and not want to live there for another reason, he's going to get probably a lot more out of it.
Well, he still has to pay off the loan, though.
He's still
if he gets an insurance check and he decides to sell it for, whatever. Burnt down, he still has to pay off the loan.
Absolutely.
I explained that to him. I think he thought he didn't have to pay it off. Take it and go.
A lot of people think, and this one time say, "Oh, I'm just going to, give the lender my keys back." Well, keep in mind the lender didn't pick the house, right? The buyer picked the house. The lender is simply lending you the money. They didn't pick the house. They don't really care. The only thing that house is to them is a security instrument.
That's right.
So, if something happens to the house afterwards, the lender, is really not involved in that. We got an appraisal, not a home inspection, not anything else. We simply got the appraisal on it to make sure that if something happens, we could resell it on a foreclosure. And there's a good chance that we get the money back for that. But now if the house is not in that same condition, then, then there could be an issue, which is why we require the insurance, and it has to have the correct coverage in there to protect the lender in the event that something does happen, so that lien does get paid off. Yes.
So that's an interesting one. I had another one that it was years and years ago when I was managing a team, and we had a listing. And we got an offer on this listing. And then when they pulled the insurance or tried to get insurance, it was outrageously expensive. So we went back to our seller and said, well, did you ever make any claims on that house? And they said, well, yeah, we went on vacation and we came back and the toilet had leaked. And when we came back, the toilet was in the living room, came right through the ceiling, right to the living room floor. And so they took the money and went on another vacation.
Wow. So yeah. Well, ultimately, even if they have it fixed, now there's that claim. Against it. But again, that's what insurance is for: is there to protect you in the event that something happens. So that's good. Well, and here's another one: is not just homeowners insurance, right? How about flood insurance?
Flood insurance. So that is another podcast, Darlene.
Oh no, we need to get an insurance person on here. That would be
we sure should. If anybody out there that wants to take that on, we're happy to let you, because
we would love somebody. There's so much to this homeowners insurance, and I think we're like, okay, tell the buyer, go shop for your homeowners insurance, because again, as a lender, we don't get the insurance, and as an agent, you don't do the insurance. Right? They have to shop somebody, so they get to shop whoever they want to use. We just have to make sure it has the proper coverage on it. But if the property is in a flood zone, now we have to make sure that they have flood insurance on it, and that it also has the correct coverage on it. Right. So and that will really vary depending on the elevation of the property.
So I'm in two different markets, as you know. In Virginia, that's a due diligence. That does not have to be disclosed up front. I mean, So you have, well, I do as an agent, I interview my buyers and say, are you okay with being in a flood zone? Because especially in Virginia Beach, the flood zone is very prevalent.
Everybody is in a flood zone.
Right.
It's not, are you in the flood zone that requires flood insurance?
Flood insurance, exactly. You are. You are. Yeah. So, whereas in Arizona, you have to disclose that it's in a flood zone.
Really, right up front.
Right up front. It has to be disclosed. But in Virginia, it's a due diligence issue. Yeah. You do your due diligence. If you want to be in a flood zone, if you're okay with it, then you're all right. And like you said, every house in Hampton Roads is in a flood zone. The question is it elevated to the point where you have to pay more insurance than the average buyer?
And is it required by the lender to have it?
And is it required? Which
because
not
anybody can get flood insurance.
Right. You're absolutely
and if it's not,
right.
and the lender doesn't require it, you can still pay for flood insurance. You can have it on your own. Usually it's cheaper if it's not required.
Right.
But if it's in a flood zone, the lender's going to require it. Now it has to be a part of the loan, and we have to see it and make sure it has enough coverage and all those things. So it's whether or not it's required. For that. And one of the things that we're going to do when we get that loan, we got that ratified contract, right? We ordered an appraisal, right? And now we're going to order a
that's
flood
going to come out. That's going to come out.
And then, so we also have something on our, fee sheets that's called the flood certification. So we're going to use an independent third-party company to tell us whether or not it's in a required flood zone, right? And whether or not they'll need flood insurance, which can make a huge difference on it.
It really could. It depends, because I've sold homes on the water. I mean, the backyard is the water. I sold this really cool house in Virginia Beach about maybe 5, 6, 7 years ago, where it almost looked like it was on its own island. The house is here, and the house was surrounded, like a horseshoe of water. They loved that house, but you know what? When it rained, they didn't love it.
If you knew that it was going to have water and to deal with that and the consequences from water and dealing with that all the time. Yeah. So it's nice to know, like, right up front.
So that's a good one for an insurance person, insurance guest. The fourth one, before we run out of time, because we're sneaking up here, can you believe it?
So fast.
It's probably the most common, I would say, the most common call that I get from my loan officer is undisclosed debt.
Yeah, they didn't qualify because we found a debt that they didn't tell us about.
They didn't tell us about.
And there's a lot of ways that we find out about that, right? So again, we always try to ask all the questions right up front. We try to, my biggest thing is if you give me all the information up front, I can make the best case for you and we can handle it. But when it comes up as a surprise, we might have pushed you to the limit and it may have just taken you over the edge, right? So an undisclosed debt, a lot of ways, that we find out about them is usually, we require bank statements. So let's say on the bank statement, all of a sudden you got this IRS payment coming out there.
That's common.
It really is common. We see it more than people think because we're asking them about, what are your debts, and we're pulling a credit report and they all show up there. But guess what doesn't show up there is an IRS lien. Right. And an IRS is a debt. So we have to ask them, is there any other debts that wouldn't show up on the credit report? And a lot of times it's just on an automatic payment and they just completely forgot about it. I really believe people don't do it on purpose. Some might, or think that we won't find out. But most of the time we will. So we would just, if we look at the bank statements and see an IRS payment coming out, now we got to go back to the buyer and say, we need you to explain this. We need a copy of the payment plan. We need to know how much you owe and what you're paying.
And it's not that you can't purchase a house if you have an IRS.
IRS lien. Yeah. As long as you if it's unpaid lien or judgment, maybe a different story. But if you've got a payment plan on it, we do loans all the time with somebody with an IRS payment plan. We just have to make sure that we count that payment in the debt to income ratios, right? So that we know that they qualify with that payment. So if you've got somebody who's what we call a fencer deal, and you get an IRS debt that shows up, it could just fall on the wrong side of the fence, and now they don't qualify anymore. Wow. So one of the things to do is really make sure that as you're a borrower and you're talking to your lender, make sure you tell them about any debt that you have, whether it's on your credit report or not. So we've got the IRS lien that could be one. Any new liens, sometimes it takes, 30 to 90 days for a new debt to show up on the credit report. You bought a car last month. I pulled a credit. I'm qualifying you. I don't see a car note on there, right?
Right. So, but then now it's showing up.
And there's this little thing called inquiries. The minute somebody pulls credit on you, they have an inquiry. So, and it's probably the thing that most borrowers get like, what do I have to do this for? You have to explain any inquiries on your credit report because it takes that long for a new debt to show up. So any inquiry, you have to tell us whether or not you opened up a new debt. And if you opened up a new debt, somebody's shopping at the department store and they're going to give you 10% off if you fill out a
credit card.
Right? No, and then you got the application. Now you use it that day. Now you have a debt. And that we're going to ask you about that inquiry. You're going to go, oh, yeah, I did go to the department store that day. Oh, yeah, I did charge that. Oh, now I need the bill. And we can either pay the bill off at closing so that it doesn't affect you, or I have to count that payment against you in qualifying. So right before closing, a lot of people forget about this, but right before closing, we have to, within usually 5 days of closing, refresh the credit. We don't re-pull a credit pull unless the credit report's actually expired. We just refresh it, which means if there's any new debt up there, we have to question and find out if we have to use that for qualifying. So that's an undisclosed debt.
So what happens if you co-sign for somebody?
It's your debt. When you co-sign,
even if you don't pay it, I mean, even if, the other somebody is paying the bill and you don't see that. And I think we've all been
there are some
guilty.
Yeah, there are some exceptions, but I think the most important thing for somebody to remember before ever agreeing to co-sign for somebody is if that person doesn't make the payment, it's your responsibility. When you co-sign, you're saying, I am taking co-responsibility for this debt so that if this person doesn't pay, then I will be paying it. So that's why we have to count that against you in most cases. Now, if you co-sign for somebody like on a house note, I've seen this where parents have co-signed for their kids for a house, which, is done. So as long as, some loan programs, and I'm not going to say all of them, but some loan programs will allow you not to count that debt if you co-sign, as long as you prove that that person has made all the payments out of their own account. Now, I actually just pulled one up last week. And unfortunately, he couldn't understand why his credit score just dropped drastically. And then I looked on there and I went, "You're 2 months behind on a house payment. Is this your?" He's like, "No, I co-signed that. I had no idea."
Oh no!
So, and because it's now late, I have to count that debt against him in qualifying. Not only that, now he's got 2 late mortgage payments on his credit report, which makes it hard to get qualified. So just be real careful about co-signing for somebody, because yes, you do have to count that debt. Again, like I said, there are some exceptions. If you can prove that the other person made that payment out of their bank account for the last 12 months, then a lot of times we can go forward and not close and count that debt. But if the debt's been late in the last 12 months, you still have to count it because that co-signer is now responsible for that debt.
Wow.
Now, the only, there's the other thing there too, where sometimes, parents will put their kids on as an authorized user on their accounts and things like that too, which is good because it could help their credit. But at the same time, it could hurt their debt to income ratio because you have to count that debt if it's on there. Now, sometimes we can have them removed as an authorized user and then you're fine. You don't have to count the debt. But yeah, it's a debt that could be counted against them. Oh, and another one that we run into a problem with on VA loans. So again, I've always said I love VA loans. They're like the easiest ones to qualify for. They're 100% financing, and they use real life situation for qualifying, like residual income, right?
Right.
And you can definitely exceed the ratio as long as they have enough money left over based on the number of people in the family. Obviously, you've got a single veteran. He doesn't need as much money at the end of the month as somebody, say, who's married and has 5 kids, right?
Right.
So I call it real world, qualifying. But the other thing is VA also counts childcare as a debt.
Oh, yeah. We have one. You and I, which we're like, and childcare is expensive. I didn't realize how expensive it is.
So you don't necessarily have to count it on FHA or conventional loans. They don't really think of that as a debt. But if you were an underwriter and really trying to figure out this one's tight, this is whatever, and now you've got kids that are in child care, you have to think that is an actual expense that somebody has to pay, right?
Yeah.
So when you're looking at what we call residual income, we're actually looking at that childcare as a debt. So if you've got a VA buyer and it comes to, and all of a sudden they're saying, "Oh no, we don't have childcare. We just, take turns with the kids." And
they're going to wonder.
People do that. And then we get the bank statement and there's childcare on it every week that gets put out. Well, now I have to count childcare as a debt, and that could definitely, childcare is expensive. That could definitely be a big
I can't believe how expensive it is.
Yeah. So those are pretty much the things that will come up on undisclosed debt. But again, as soon as we get that ratified contract, one of the first emails we send out to the borrower is, "Do not open any new debt."
Oh gosh, I had one that went out and bought a washer and dryer.
Yeah,
and it disqualified her from the loan. I couldn't believe it, and I said, "Girl, you got to take that back." Yeah.
And it will. And a lot of people think, well, how are they going to know? Because we're going to refresh the credit for any new inquiries right before closing.
If it's that tight.
So close, then go buy your new washer and dryer. What you do after closing is totally up to you, right?
Yeah.
But if
Or
you
at
do
least run it by your lender. I know when I bought a house, I ran it by my lender, which was you. Can we go out and buy this furniture? Can we do this? Can we do that? So you're going to know better than us.
And I always say do that. I actually was working with a buyer that was transferred here from Hawaii. So one of the things he said is, we're not going to bring our cars from Hawaii back. We're just going to sell them in Hawaii. And when I get there, I'm going to have to go buy a car. I'm like, great. He says, I've already talked to another car dealership, and this is what my payment's going to be. So I'm going to be looking for a car around, this, 20, 30,000. My payment should be this. So right in the beginning, I added that as a debt. And then when he got there and he got the new car, I had to get the information and have it added to the credit report, but we knew ahead of time. It wasn't an issue because we knew ahead of time what that payment was going to be, and we factored it in. So sometimes you just, rather than him having to wait to buy a house, right, until after, so he as long as he knew up front what he was going to be doing when he got here, we can work around those issues. But that's why I said communication is key. It really is key. And I always say, one of my old saying is, I kind of think of myself as, a lot of people understand the judicial system, right? So you have, the attorney that's there to make the case for you, and then they have to bring it before the judge, which in our case, we have to bring it before the underwriter. So give me everything right up front so that I can make the best case for you so that when we take it to underwriting, there's no issues.
Yeah.
So then I used to say the paralegal's like my processor. She's the one who's going to gather all the paperwork and look at everything. But yeah, we're there to represent the borrower, right? But the more information you give us, then we can look at those loan programs that fit your need specifically. So
it's not that you can't buy something. It's not that you can't have insurance. It's not that you can't be in a flood zone. It's not that you can't go over the list price if you're competing. You just need the communication key.
Absolutely.
And the information, on how to do that.
Right. And a lot of these things that come in after the fact, right, we all know that they could happen. So we always just try to prepare every borrower in every situation for the what ifs. That way you have a better chance of it being a smooth closing transaction from the time that you got a ratified contract till the time of closing.
Right.
We've worked in it. We have ideas of things that could happen. So we try to prepare the buyers as much as we possibly can and try to educate them as much as we can. Don't do this. Don't do that. They actually get an email from me. Don't do this. Don't do that. Do this.
I've gotten those emails
Don't
from
get
you.
fired. Yeah.
I've been on the other end.
Yeah. Yeah. And then, so what if all these, what if one of these contingencies do come up and it actually makes the deal go south? And now what happens to the buyer at that time? Because a lot of times people question, what about my earnest money deposit? What the deposit I made with the contract?
Well, and it's funny because that can be a sticky situation sometimes, especially in Virginia, because everybody has to agree to return that earnest money deposit by signing off on a release. So sometimes if it disqualifies you from the loan, and that is written in the purchase agreement, if you are disqualified from the loan because of certain issues, then you automatically are supposed to get your earnest money deposit back.
Right. So if the insurance comes in way too high, or then it's in a flood zone, and then and you're disqualified, they can get that earnest money deposit back in most cases. Then, right?
Yeah, but if you're disqualified, I had a situation just recently. I was the listing agent, and the buyer that we had, he came in beautiful on his offer. It was over. Everybody jumped through every hurdle. And then we get to a week before closing, and the money that his down payment was supposed to be, he didn't have it. He never had it. So it disqualified him from the loan. In that case, that was deliberate.
Yeah.
Because
that should have been something, that should have
been disclosed
right on the loan
up front.
Application. How much funds do you have?
Right.
And, if you didn't have it and you put a number there and we tried to verify and couldn't get it, You're right. That's kind of
that was a little deliberate, and I
like
knew
going out and getting new debt. That's not, you may be disqualified, but you were disqualified because you went out and got new debt. Kind of
that's deliberate.
Or you spent all the money, and now we can verify it. Yeah. So those are deliberate things. Yeah.
So he lost his earnest money deposit. I mean, I knew the questions when the situation came up. I kind of sat back and I was like, well, when you put in an offer and you say, because there's a line on there that says how much money you're going to put down and, how much are you paying versus the seller paying for closing cost assistance. If you have all those boxes checked and you say, I have that plus that, then you need to have it on day one, not put in an offer, get the house, and then spend 30 days trying to get it. So I knew the questions to ask, and fortunately, the agent answered honestly. And when the agent answered honestly, I knew at that point there are no blames, at least not with me. Yeah, I'm a very factual person, so I didn't blame anybody. I just said the facts is the buyer didn't have the money the day that they signed this purchase agreement was ratified.
The seller took his house off the market in good faith.
That's right. That's right.
So that's kind of what the earnest money deposit there is for.
Yeah, he lost his earnest money deposit, not easily because, of course, they fought to keep it. Right. But, I kept going back to the paragraph in the purchase agreement that says that is called default.
Right. And that's, But sometimes they'll ask me that question. It's like, that's the time to call your agent.
An agent that knows, that understands the purchase agreement.
I always say when it comes to the lending, I can, give you guidelines on loans, and I can tell you what your closing costs are. And I can tell you how a lender will look at a contract, but the negotiations really are left to the agents involved. And that's why it's going to have a good one there.
So we covered the top four hurdles. We're coming in as the garage door is closing. We're slipping in.
So now we'll definitely have to think about what our next topic will be. We had a couple comes up that I think will be good ones for the future. But
absolutely,
if anybody out there has any ideas for topics, definitely reach out. Let us know.
Yeah, reach out. And thank you for the people that reach out and give us feedback on our podcast. I love it. Yes.
Yeah, absolutely.
All right. Awesome. Until next time, Darlene.
Coffee and Keys is brought to you by Darlene Kemp, VP, Senior Loan Officer, NMLS ID 173897. Atlantic Coast Mortgage, LLC is an equal housing lender. NMLS ID 643114. www.nmlsconsumeraccess.org. And Crystal Jacques, Realtor for both RE/MAX Allegiance, 4000 Virginia Beach Boulevard, Suite 164, Virginia Beach, Virginia 23452. Office phone 757-490-7300. And RE/MAX Professionals, 20,241 North 67th Avenue, Suite A1 Glendale, Arizona 85308. Office phone 623-362-3000. Each office is independently owned and operated and supports the Fair Housing Act and Equal Opportunity Housing.